You made 17 financial decisions today before lunch. You don't even remember most of them. The coffee at the gas station, premium or regular fuel, that sandwich from the deli, whether to tip, the online subscription renewal that popped up on your phone, each one pulled from the same mental tank of energy. And by the time the market dipped this afternoon, that tank was empty, so you sold. This isn't a story about lack of willpower, it's neuroscience. Social psychologist Roy Baumeister discovered something remarkable in 1998 that changed how we understand human decision-making. He brought college students into his lab and put two bowls in front of them. One held warm chocolate chip cookies, the other held radishes. Half the students could eat cookies, the other half they had to resist the cookies and eat only radishes. Then Baumeister gave both groups an impossible puzzle to solve. The cookie eaters persisted for 19 minutes on average, but the radish eaters, 8 minutes, they quit. Resisting those cookies had drained something in their brains. Baumeister called it ego depletion. Every choice we make depletes our mental resources like a muscle getting fatigued after repeated use. Now imagine you're 57 years old. You've been making choices since 6 a.m. which bills to pay first, whether to refinance. Should you increase your 401k contribution? The price of groceries shocked you, so you had to decide what to put back. Your health insurance sent another confusing letter about coverage changes. You checked your investment account 3 times because the market was down. By evening, your brain is running on fumes. This is when the damage happens. This is when wealth gets destroyed. A groundbreaking study from the University of Michigan tracked investor behavior during the 2008 financial crisis. Researchers found that exhausted investors were far more likely to panic sell during market dips due to what they termed mental overload. The pattern was unmistakable. People who made major financial decisions late in the day showed dramatically higher rates of selling low and buying high. Here's what makes this finding devastating. The investors who sold during the panic of March 2009 missed the entire recovery. The S&P 500 climbed 69% over the next 2 years. Millions of Americans locked in losses because their brains were simply too tired to think rationally. The cognitive toll is measurable. Recent research published in the journal Chronobiology International examined how time of day affects economic decisions. They tested participants at 9 a.m. versus 5 p.m. Morning participants showed significantly higher proactive control and more cautious decision-making. Evening participants, they made faster, more impulsive choices, especially when facing uncertainty. Think about when you make your most important financial decisions after a full day at work, after dinner, late at night when you can't sleep worrying about money. This is precisely when your prefrontal cortex, the part of your brain responsible for rational planning, is least effective. A study analyzing thousands of financial analyst forecasts revealed something startling. Analysts who released earnings predictions during weekday non-trading hours, primarily evening hours, showed significantly lower confidence in their forecasts. Why? The psychology literature tells us that circadian rhythms lead to lower attention levels and poorer cognitive performance in the evening. But here's what really matters. Decision fatigue doesn't just make you tired. It fundamentally changes how you evaluate risk and reward. Researchers examining parole board decisions in Israel discovered judges granted parole to 65% of prisoners early in the day. But that number dropped to nearly zero right before breaks. After judges ate and rested, the approval rate jumped back to 65%. The fatigue didn't just make them harsh, it made them default to the safest option, which was denying parole. Your investment decisions follow the same pattern. When you're mentally drained, you don't carefully weigh options, you default. And for most people, the default during market stress is panic. Studies on retail investor behavior during market volatility show this clearly. When facing portfolio losses, investors with depleted mental resources displayed what researchers call loss aversion on steroids. They were more likely to hold losing investments too long, hoping to avoid realizing the loss. Then when volatility spiked, they would suddenly capitulate and sell everything, often at the worst possible moment. The research from behavioral finance journals is unanimous on this point. Cognitive biases like loss aversion, herding behavior, and confirmation bias intensify when investors are mentally fatigued. During the COVID-19 market crash in early 2020, panic selling was most pronounced among retail investors who managed their portfolios after work hours. Here's a real case study. Meet Tom, composite character based on research data from over 200 investor surveys. Tom's 53. He works in manufacturing. Good income around $85,000 a year. He checks his retirement account regularly, sometimes twice a day when markets are volatile. In February 2020, he watched his portfolio drop 8%. By March, it was down 22%. Every evening after dinner, he'd log into his account. His stomach would drop. The red numbers felt like physical pain. On March 18th, after a particularly brutal day at work dealing with layoff decisions, Tom sold everything, moved it all to cash. His 401k balance was $340,000. He locked in a loss of $94,000. The market bottomed 5 days later. Tom didn't buy back in until July 2021 after missing a 75% rally. His decision to sell made at 9 p.m. after an exhausting day cost him approximately $187,000 in potential gains. Tom isn't stupid, he isn't weak. He was simply making a crucial financial decision at the exact moment his brain was least equipped to handle it. The neuroscience explains why. A 2024 study using fMRI scans showed reduced activation in the prefrontal cortex during decision tasks following periods of high cognitive load. Your brain literally shows less activity in the regions responsible for rational thinking when you're depleted. Now here's the part that changes everything. Automated investing solves this problem, not by making you smarter, by removing decisions entirely. Consider dollar-cost averaging. You commit to investing $500 every paycheck into a diversified portfolio. No decisions about timing, no checking the market, no emotional reactions to red numbers. The research on this is striking. A Vanguard study analyzing investment returns from 1976 to 2022 found that while lump sum investing slightly outperformed dollar-cost averaging in raw returns, the behavioral benefits of automation dramatically improved real-world outcomes. Why? Because automated investors never panic sold during crashes. The enhanced dollar-cost averaging study from the University of Nebraska showed even better results. Investors who automated their contributions and adjusted amounts based on simple market signals achieved higher dollar-weighted returns between 60% and 95% of the time, without making a single discretionary decision. But here's what researchers found most significant. Automated investors slept better. Literally. Studies measuring stress hormones and sleep quality showed that people using automated investment strategies had significantly lower cortisol levels and better sleep patterns than active investors, especially during market volatility. Less stress, better sleep, more wealth. A comprehensive analysis of Swedish investor behavior confirmed these findings. Investors using systematic automated strategies showed lower portfolio turnover, paid fewer taxes on gains, and accumulated substantially more wealth over 30-year periods than investors making active decisions. The mechanism is simple. Every time you remove a decision from your daily routine, you preserve mental energy for decisions that truly matter. Barack Obama wore the same color suit every day. Mark Zuckerberg wears the same gray shirt. Steve Jobs had his black turtleneck. These weren't fashion statements. They were cognitive conservation strategies. The same principle applies to your investments. Automate, set it, forget it. Research from behavioral economics shows that the psychological benefits compound over time. When you automate your investing, three things happen. First, you eliminate market timing errors. A study published in the Journal of Financial Planning found that the average investor underperformed the market by approximately 3.7% annually, primarily due to poor timing decisions driven by emotion and fatigue. Second, you reduce transaction costs. Frequent trading triggered by daily decision-making erodes returns through fees and taxes. Automated long-term investors keep more of what they earn. Third, and this is crucial, you prevent the devastating mistakes that occur when you're mentally depleted. Those late-night portfolio checks. Those panic sells during market drops. Those impulse buys during rallies. Automation removes the opportunity for fatigue-driven disaster. Consider this scenario. Two investors both earn $75,000 annually. Both start with nothing at age 35. Both contribute 15% of income to retirement accounts. Investor actively manages his portfolio. He reads financial news daily. He adjusts his allocation based on market conditions and how he feels about the economy. He checks his account multiple times per week. During the three major market corrections over his career, fatigue and stress lead him to sell and move to cash each time near the bottom. His average annual return 6-8%. Investor B automates everything. He sets up a paycheck deduction that invests automatically in a diversified portfolio. He rebalances once annually using a preset rule. He rarely checks his account. During market corrections, his automatic purchases buy stocks at lower prices without requiring any decision from him. His average annual return 9.3%, that too 5% difference. At age 65, Investor B has $1,847,000. Investor has $1,243,000. That's $604,000 more wealth for making fewer decisions. But here's what research shows matters most for men your age. Time. A study examining cognitive performance across age groups found that decision fatigue impacts people more severely as they age, particularly for complex financial choices. The 60-year-old making investment decisions faces steeper cognitive costs than the 30-year-old making identical choices. You can't afford to waste mental energy on daily financial decisions. You need that energy for your career, for your health, for your family, for the decisions that automation can't handle. The research on investor psychology during retirement planning is particularly revealing. Studies show that men approaching retirement who actively manage their portfolios experience significantly higher anxiety, poorer sleep, and more relationship stress than those using automated strategies. The mental burden isn't just costly financially, it's damaging to your quality of life. Let me give you the specific action steps that science supports. First, automate your contributions. Set up direct deposit from your paycheck into your investment accounts. Never see the money, never decide whether to invest it. The decision happens before your brain has a chance to interfere. Research shows that people who automate contributions invest 40% more over their lifetimes than people who manually transfer funds, simply because the automation removes the opportunity to skip months or reduce amounts. Second, use target date funds or simple index portfolios that automatically rebalance. Every adjustment you make manually is a chance for fatigue or emotion to drive a poor choice. Let the fund do it. Studies comparing self-directed investors to those using automated allocation strategies found that automated investors achieved significantly better outcomes, not because the algorithms were smarter, but because they never got tired. Third, limit how often you check your accounts. Research is clear on this. Frequent monitoring increases emotional reactions and leads to more harmful interventions. Once per quarter is sufficient for investors over 50 who are focused on long-term wealth. A fascinating study tracked the portfolio performance of deceased investors, comparing their returns before death to returns after death when the portfolio remained untouched. Dead investors outperformed living investors. Why? They couldn't make decisions, they couldn't panic, they couldn't sell low. You don't need to die to get these benefits, you just need to automate. Fourth, if you must make adjustments, schedule them during your peak cognitive hours. Research on chronotypes shows most people think most clearly between 9 a.m. and 1 p.m. Never make financial decisions at night. Never make them unstressed. Never make them tired. But better yet, don't make them at all. Set rules in advance and let automation execute them. The compound effect of these strategies is profound. A 2022 analysis of retirement account performance found that investors who combined automated contributions, automated rebalancing, and minimal monitoring achieved returns that exceeded actively managed accounts by an average of 2.8% annually over 20-year periods. Over 20 years on a $300,000 portfolio, that's the difference between ending with $124,000 versus $789,000. That's $335,000 created not through superior intelligence or market timing, but through eliminating decisions. Think about your day tomorrow. You'll wake up and immediately start burning through your mental reserves. Work, family, health decisions, the news, traffic, bills, problems. By evening, you'll be running on empty. That's when the stock market news will catch your eye. Some analyst will predict a correction. Your portfolio will be down. You'll feel that familiar anxiety in your chest. You'll want to do something, but if you've automated your strategy, there's nothing to do. The decision was made months ago. Your contribution goes in regardless. Your allocation rebalances automatically. You can turn off the TV and go to bed, and while you sleep, your wealth compounds, protected from the decisions you would have made when your brain was too tired to protect you. The hidden psychological cost of financial decision fatigue isn't just stress or poor sleep. It's the wealth you never accumulate because exhaustion made you sell low and buy high. It's the compound interest you miss because decision fatigue convinced you to move to cash during corrections. It's the decades of potential growth lost to a choice made at 10 p.m. after a terrible day. You can't eliminate decision fatigue from your life, but you can eliminate its impact on your wealth. Automate, simplify, protect your future self from the decisions your tired present self shouldn't make. The research proves this unequivocally. Less mental effort yields significantly higher financial returns. Not because thinking is bad, but because the moments when you're most tempted to act are precisely the moments when action destroys wealth. Your brain has limits. Honor them, work with them, and let automation carry the cognitive load that crushed Tom and millions like him. Here's what I need you to do right now, before you move on to the next thing, before decision fatigue makes you procrastinate. 1. Subscribe to this channel and hit that notification bell. I'm going to share more research-backed strategies that can dramatically increase your wealth without requiring you to become a financial genius. You'll want to catch every video. 2. Write down 3 financial decisions you make repeatedly. Could be checking your portfolio, deciding how much to invest each month, timing when to buy or sell. Write them down. 3. Within the next 48 hours before you forget, before you get busy. Before decision fatigue makes you put this off, automate at least one of those decisions. Set up automatic contributions, switch to a target date fund, delete your trading app, anything that removes one choice from your daily burden, because the research is crystal clear. Every decision you automate is wealth you protect. Every choice you eliminate is mental energy you preserve. Every automated strategy you implement is a future panic sell you prevent. Your wealth isn't destroyed by bad luck or market crashes. It's destroyed by decision fatigue at 9 p.m. on a Tuesday in March. Automation is your defense, simplicity is your strategy, and the wealth that compounds while you sleep is the reward. I'll see you in the next video, but only if you hit that subscribe button right now. Don't decide to do it later. Your tired brain will talk you out of it. Automate the subscription. Automate your investing. Automate your path to wealth. Let's build this together.